Good evening and welcome to today's market wrap. Let's start with the numbers. The Nasdaq closed at 26,402, up 1.2%. The S&P 500 gained 0.58% to finish at 7,444. But the Dow Jones Industrial Average bucked the trend, falling 0.14% to end at 49,693. The divergence here is striking. The VIX Volatility Index edged lower to 17.87. The 10-year Treasury yield continued its climb to 4.48%. The dollar index strengthened to 98.45. The offshore yuan traded around 6.7873. Bitcoin slipped 1.52% to $79,428. Crude oil was little changed at $100.88 a barrel. Spot gold edged down 0.1% to $4,704.50. The defining characteristic of today's session was extreme structural divergence. The Nasdaq was pushed to a new high by the AI and semiconductor frenzy. But the Dow's decline, combined with the signals from the bond and currency markets, tells us this rally lacks a solid foundation. The capital flow was crystal clear. Money is rushing headlong into AI and chip stocks, with some spillover into crude oil. Defensive sectors, financials, and even cash are being left behind. This is not a healthy broad-based bull market. This is an index being held hostage by a handful of mega-cap stocks. Let's walk through the global session step by step. Asia was the trigger for today's global risk-on mood. Markets opened cautiously, digesting the negative surprise from U.S. inflation data. But sentiment reversed sharply on news of a potential U.S.-China summit and a report that Jensen Huang would travel to China with President Trump. China's Chi-Next index hit a record high. South Korea's Kospi surged 2.63%, led by Samsung and SK Hynix, completely reversing the previous day's pessimism. Europe picked up the baton cleanly. Tech and oil stocks led the charge, confirming and amplifying the risk-on tone. Then came the U.S. session, where the divergence was taken to the extreme. The Nasdaq opened higher and never looked back, driven by AI leaders like Nvidia. But the Dow was under pressure all day and closed in the red. This is a textbook case of capital rotating out of the old economy and into the single theme of AI. Market breadth was terrible. The entire rally was dependent on a handful of the largest companies. Today, we saw a very dangerous structural signal emerge. We are calling it the decoupling of tech stocks from macroeconomic fundamentals, and we put the probability at 85%. Specifically, the market completely ignored two major red flags. First, the 10-year Treasury yield climbed to 4.48%. Second, the dollar index strengthened to 98.45. In any classic pricing model, these two factors are poison for growth in tech stocks. The market's indifference tells us that the AI narrative has temporarily overwhelmed the logic of macro discount rates. This is a sign of extreme market strength, but it is also a hallmark of a structural bubble. This decoupling is unsustainable. It will end one of two ways. Either the macro economy will eventually catch up to the optimistic assumptions priced into tech stocks, or the tech bubble will burst and snap back to macro reality. We believe the probability of the latter scenario is increasing. For tomorrow's Asian session, we expect a higher open, but intraday volatility will spike. Chasing tech stocks at these levels carries enormous risk. The safer strategy is to watch the capital flows after the open. If non-tech sectors start to decline, it will be a clear signal that overall market risk is being exposed. On the sector front, AI and semiconductors were the strongest global consensus theme today. Nvidia's market cap has now surpassed $5.5 trillion. Anthropic is valued at over $900 billion in its latest funding round. The technological revolution narrative continues to feed on itself. In China, A shares, green power and grid equipment were strong, supported by domestic policy and expectations for peak summer electricity demand. The weakest sectors were U.S. financials and utilities, both highly sensitive to rising interest rates. Tomorrow, keep a close watch on the U.S. initial jobless claims and producer price index data. Any upside surprise in inflation or labor market tightness could be the spark that pricks the bubble of tech stocks ignoring macro reality. The transmission mechanism would be a further spike in Treasury yields. Our core message for tomorrow is this. The question is no longer whether the market can go up. The question is whether the current rally structure is healthy and sustainable. If the divergence between the Nasdaq and the Dow does not narrow, if the VIX starts to rise from its low level, or if we see cracks forming within the leading tech stocks themselves, investors should be on high alert. Today's market is like a sports car with its front wheels spinning furiously while the rear wheels remain stationary. The faster it goes, the greater the risk of a catastrophic spin out.